Well, good morning, everyone, and welcome. Today's Masterclass is the fourth, actually, in our series. And today we're going to specifically focus on capital gains tax and the small business CGT concessions. So a bit of introduction. This is the fourth session in our series, and we're going to move through reasonably quickly, but wanted to just share with you a couple of bits of background information. As I said, today's topic is all around the small business CGT concessions. We're going to talk specifically about how they apply to business owners that are looking to or preparing for the exit, sale, handing on to family, whatever that might look like. Obviously, those concessions apply to those people differently. We're going to talk through that in a little moment. First, a bit of background. We've already had 3 of these sessions so far this year. We started back in February. They're on every month, so if you're interested in succession-related topics, please feel free to join. They're all free. All you have to do is register online and come along. So today, as I said, number 4 in the session. The next couple of months, we've got some interesting topics. We're going to talk about family business succession, and we're going to specifically look at maximising value, employee share plans, and then some of the M&A type topics around strategic sales and M&A as a process. A little bit of background. I've done a lot of work in this particular area. I did some work just after completing my master's degree in taxation law. I specialised and advised accounting firms on using the capital gains tax concessions for their business owners that were approaching retirement or looking at exiting their business. So I've done a fair bit of work in this space. Our Business Succession Plus is entirely focused on business owners and exiting. And one of the things that we do, obviously, is prepare for the taxation outcome. So we're going to cover off on that specifically today. In business with Don and Scott, both Queenslanders, which is good and bad. It's bad at this time of year because State of Origin's coming up, but it's generally pretty good. They're not bad blokes. We've also got an accredited advisor program, which is something that a lot of people that have attended this seminar series have actually asked about. We have a number of accredited advisors, about 26 all around the country in regional towns, capital cities, etc. We are looking for more of those people, particularly in Victoria. We're very underweight or underrepresented in Victoria. So would certainly have a look at that website if you wanted to find out more information. I'm also very happy to chat to you about that. Now, let's have a look at how this fits into overall what we do around succession planning, and then we'll get specifically into the capital gains tax stuff. Firstly, you'll see that the tax planning aspect is around step 16, but don't take that to mean that it's left until last. There's a lot of preparation obviously goes into this, but if you have a look at things like step 4, where we're talking about financial planning, obviously some of that is around structures and ownership of assets and the taxation implications of that ownership. So you'll see that we cover that off on the way through as well. But specifically, we're talking about step 16 today, which sits into our stage 4 process around the actual exit transaction. And that's an important aspect. Taxation is obviously very important. The main reason is that a lot of our clients, this is their main source of funding retirement. They'll hopefully get to the point where they can successfully sell and exit their business, and they want to make the most of that transaction. And the most of that transaction is really about the net proceeds. It's not just about the fact that I sold my business for $5 million. That doesn't make a lot of sense if you sell it for $5 million and pay 3 of that in tax, for example. So what you've got to do is make sure that you can use the concessions and you can make them available to you. They're there on purpose. This is not some tax scheme. This is legislation written into the Act by the government looking at reducing the capital gains tax impact on small business owners when they exit. And that's quite important to understand that. Obviously, there's a number of criteria, and we're going to talk specifically about eligibility criteria in a moment. But there's a number of criteria that you've got to meet to qualify, but the legislation is there on purpose. It's designed to help small business owners reduce the capital gains tax they pay when they exit and sell their business. So let's have a look at how the capital gains tax concessions work. These are grouped together in what's called the small business CGT concessions. There's 4 of them. We're going to look at each one individually, but we're also going to look at the criteria and so on that apply. In order, the 15-year exemption, very short, quick, sharp summary. The underlying model here is that if you've been in business for 15 years or more, then there's an exemption to capital gains tax. there's always a 50% active asset reduction. So not only the 50% discount, and we'll talk about that in a moment, but also a further 50% reduction if you can satisfy the active assets test. There's a retirement exemption and a rollover exemption. We'll talk specifically about exactly what they are and how they work. Obviously, the first thing is that the general 50% discount that applies to assets held longer than 12 months, depending on your ownership structure, of course, this discount is not available to companies, for example. But if you own the asset in an individual, so if we're talking about shares in your business and you sell them in your own name, then you're entitled to a 50% general discount as long as you've owned them for more than 12 months. Now, that discount applies to many, many other assets. This is not one of the small business CGT concessions. This is just a general capital gains tax rule. Came about when they changed the indexation rules, etc., and basically said that if you've held the asset for more than 12 months, you're entitled to a 50% discount. Interestingly or importantly, that's a compulsory concession and it must be applied before any of the other concessions. So it's compulsory and you must apply it if you're entitled to it. So let's look at this whole issue of entitlement and eligibility and just see how you are actually eligible to use these concessions. Now, the idea obviously is they're available to small business owners. But the key thing is we need to make sure we are actually either a small business entity or we satisfy the net asset value test. Then we have to look at meeting the active asset test, and where we're talking about shares in a company or units in a unit trust, then we have to have this thing called a CGT Concessions Stakeholder in either the company or the trust. And if the disposing entity is a company or trust, then the stakeholders in that company or trust must have a small business participation percentage of at least 90%. Now, all that makes it a little bit complicated, unfortunately, but we're going to walk through those and let's just have a look at exactly how that works. Now, the first thing to understand is we have to meet the eligibility conditions for each of these concessions, and we'll go through them one by one just to make sure people are clear on exactly what happens. There's actually a flow chart we've put together here. I've stretched it across 4 slides, which probably does make it a little bit harder to follow in one flow chart, but I'm very happy to provide it. If you email me after the session, I'm very happy to email it out with the notes, etc., that go with the session. First step is, do we have the net asset value test? Are we meeting that net asset value test? And we'll go through that in a moment. If the answer is no, that's okay. You may still have a small business entity, in which case you can still qualify. But if you don't meet the net asset value test, then you go to the next test. Are you a small business entity? If not, then unfortunately you don't qualify. And that's the basic qualifying criteria. Are you either a small business entity or does the taxpayer themselves satisfy the net asset value test? Now, if we go into scenario 2, we don't satisfy the net asset value test, but we are a small business entity. The next test then is, does the asset satisfy the active asset test? And again, we'll go through the active asset test. If not, unfortunately, you don't qualify. Then we start to get to the details. Does the taxpayer satisfy the net asset value test? No, we've already said that. The taxpayer does, however, but qualify as a small business entity. We do qualify and satisfy the active asset test. Then we have to ask ourselves, is the asset being sold a share in a company or a unit in a trust? Then we have some additional requirements that we have to meet. Unfortunately, it becomes a little bit more complicated if we're selling shares in a company or units in the trust. We go through those same questions again, and then we get to the middle question there. Is the asset being sold a share in a company or a unit in a trust? Is the taxpayer a CGT Concessions Stakeholder individual? And I'll go through that test with you in a moment. If yes, the taxpayer is an interposed entity, and do the CGT Concessions Stakeholders in the company or trust have at least a 90% small business participation percentage? Now, that sounds really complicated, but in most small to medium businesses, that's actually okay. It includes you and your spouse, and it's really about your involvement, and I'll show you how we do that test properly in a moment. If you qualify, then we can go ahead. Now, let's look at these tests in a little bit of detail to understand exactly what they look like, because it's quite important to get the detail right here. Firstly, net asset value of the CGT assets less the excluded assets owned by the following entities are no more than $6 million. Now, just before the event occurs, I've actually had a case where a client said, well, you know, that as of 30th of June last year, that was okay. I now want to sell the asset on the 10th of May 2018, and I'm no longer okay. It's actually relevant right before the CGT event occurs. So unfortunately, you can't use last year's accounts or anything like that to establish that you weren't over that test of $6 million back in June last year. That has no relevance. It's right before the CGT event. So the key thing here is we're talking about the taxpayer themselves. So let's assume it's Craig West. Entities connected with the taxpayer, and we'll talk about that in a moment, but that would be my family trusts, any trading entities, etc. All of that's grouped together. And then CGT affiliates, and we'll talk about that again, or entities connected with small business CGT affiliates of the taxpayer. So this is not just about Craig West and his personal net asset value and wealth. It's actually about associates or affiliates and other connected entities. So it's quite important to understand how that works. Let's have a look in a little bit more detail. Firstly, if the partnership exists and the tax Craig West is in partner with John Smith, the net asset value test only counts the assets of the relevant partner, Craig West, not the partnership as a whole. So that's important to understand how that works. Most liabilities are actually deducted. So there's some different ways to calculate certain things there, like things like annual leave. But if you've got liabilities, we're talking about net asset value. So it's important to understand that if you own, for example, I own an investment property worth $500,000, and I've got a $300,000 mortgage or loan on that investment property, the number we're talking about is $200,000, not the whole 500. So that can significantly reduce the total. Obviously, we're talking about net asset value. Now, there's also some exclusions, which is good. So firstly, if we've got connected entities, we need to be careful of that. So interest in another entity, we don't want to double count things. So we can't include things twice. We need to exclude those for the net asset value test where those interests are in another connected entity or an affiliate, because we're going to count them that way. Assets excluded for individuals, and this is important to understand. Asset used solely for the enjoyment of an individual or their affiliate. Common examples of things like that might be a jet ski, for example. Main residence is obviously an important one. So your home, your principal place of residence is excluded, obviously as long as it's used for private purposes and you actually live there, etc. An insurance policy on an individual life. So if you have one of the older whole of lifestyle policies, they can be excluded as well. And obviously the other thing that's important to understand is superannuation assets, so self-managed super, etc. It's important to understand that that's excluded as well. So the basic rule that I talk to people about is really exclude the value, the net value of your home, and exclude superannuation assets and insurance assets, and pretty much everything else is going to be counted in your net asset value test, and you need to include that. And ultimately, that all needs to add up to something less than $6 million. So if the small business entity test, which is actually much simpler to apply, you don't need both of these. You need one or the other, by the way. You don't have to have both tests met. You need one test or the other. So the SBE test is simply used to determine whether the entity is itself a small business. Now, one of the problems with this is there are multiple definitions of small business, even within the Tax Act. If you look at things like the Startup Employee Share Plan rules, you have to have aggregated turnover of less than 50 million. But here we're talking about small, and that's to qualify as a startup. To qualify here as a small business entity, then our aggregated turnover must be less than 2 million. So it's really important to understand that that test is actually quite easy. If you own a business and the business turns over less than $2 million, then it will be considered a small business entity for this particular purpose. And that's quite an easy way to do it. The net asset value test is a far more complicated being. And obviously there's a little bit we need to include and consider there. Aggregated turnover, we've heard that term before. We need to look at, obviously, aggregated, if there are other entities connected with that, or if you're trading through one entity but there's another entity that owns the plant and equipment and charges that out, or whatever it is, obviously you've got to add that together. We can generally look at the turnover of the previous income year. So if you finished your financial statements, for example, for June 2017, you can actually look at the financial statements back then. You don't have to look at May's turnover and try and annualise it or anything like that. If your turnover back then was less than $2 million, then you're a small business entity and you'll therefore qualify. Active asset test is the next one to really think about and start to understand what that actually means, because this is one of the significant qualifying criteria. Firstly, we have to make sure we've got this concept of an active asset. And the active asset simply means that it's not a passive investment asset. Often you'll get businesses, for example, I've got a trading business that operates, I've got staff and furniture and equipment and debtors and creditors and all the normal things that have got a trading. And by the way, I purchased a share portfolio worth now $5 million. That's not an active asset in terms of running the business, and therefore I'm going to have a problem because I'm going to breach this active asset percentage test because I've got this massive passive investment sitting inside that structure. Obviously not good advice to have it inside that structure anyway for a whole stack of other reasons, but it certainly causes a problem in terms of the active asset test. Now, the active asset test, unlike some of the others, is not about the position immediately prior to the CGT event. It actually looks at being an active asset for a total of at least half of the relevant ownership period. And if the ownership period is more than 15 years, then the asset has to be an active asset for at least 7.5 years during that period. So obviously this percentage will vary as the value of assets and things move up and down, etc. Then we need to do this test on each of those years to make sure that at least 7.5 years of the 15, or half the period that we've owned it, if that's shorter than 15, we actually do qualify as an active asset. So the relevant period, interestingly, starts on the acquisition date, ends on either the earlier of the CGT event and the day the business ceases. So if it ceased within 12 months before the CGT event. It doesn't need to be continuous, as I said, nor does it have to be active necessarily at the time of disposal, but we need to look at those periods. As I said, that 15-year period is quite an important consideration, and we need to make sure that we've got this active asset test for half of that period of time. So a lot of people, I've seen quite a few people make mistakes that look at the active asset position the day of or the month of or the year before the transaction or the CGT event. That's not the case. It needs to be met for that continuous period. Individuals, in terms of CGT concessions stakeholders, I talked about that in some of the earlier eligibility criteria when I talked about the fact that you have to have a CGT concession stakeholder. And what does that actually mean? It's about being, there's two definitions here and there's two words that are fairly important. Firstly, CGT concession stakeholder, and secondly, significant individual. So the significant individual that we're going to look at, that's the first thing to get our head around. What the ATO or what this legislation particularly calls significant individuals in a company or trust is that they have a small business participation percentage of at least 20%. So it doesn't have to be direct. It doesn't have to be Craig West owns shares in Succession Plus of 20%. It might be the West Family Trust, etc. But I have to have at least 20% to be a significant individual and take advantage of those of that qualification. Now, the other comment or the other phrase in here that needs some definition is small business participation percentage. What that means is the sum of the individual's percentage in the entity at the time. So if I've got 20% through my family trusts and 15% held directly, as long as my family trust, when it's diluted down and indirect ownership of those assets, I've still got that 20%. That's an important distinction. And we just need to, sometimes with complicated or detailed structures, we need to follow that path and actually do the numbers and confirm that we've actually got the right percentages, etc. Now, you've also got to look at, it's not just about ownership of shares, it's also about voting power and dividends or distribution. So it's actually quite important to understand. It's not just about doing an ASIC search and saying, okay, Craig West owns 20%. If those 20% are non-voting shares or they're G-class shares that have no entitlement to dividends, etc., then we have to be very careful around how we apply this particular test, because that will have a direct effect. And in fact, we may not qualify even though we own 20% of the shares we may not qualify on the basis that we haven't got the voting rights or we haven't got the dividend or distributions. In terms of trusts, we need to be careful again. This is about the small business participation percentage, and this is the smallest of either of these tests. So you're either entitled to capital of the trust. So if I'm entitled to 50% of the capital of the trust, and or I have to look at the smallest percentage. So the income of the trust, I might only be entitled to 15% of the income, but I'm entitled to 50% of the capital. I've actually got a problem because it's the lower of. It's not the higher of, it's the smallest or lowest of. Therefore, my 15% entitlement to the income actually means I am not qualified for the small business participation percentage because I've got too low a percentage. So very important that we don't just gloss over these qualifications and assume because Craig West owns 20% of the shares, he'll be fine. We actually need to look at the pattern of distributions and so on. So for trusts where we don't have entitlements to all of the income or capital and the trust makes an income or capital distribution, then we need to look at the smallest percentage of the distributions of income beneficially entitled to during the year or the distributions of capital that the entity is beneficially entitled to during the year. Important note at the bottom there, where there is no income or capital distribution in an income year, then no significant individual exists, and that's a significant problem, obviously. Let's have a look at some case studies to maybe better explain it, just to make sure we're clear on exactly what we're looking at. Francis, 59, no spouse or dependents, owns a successful IT company, purchased a business in 2005 for $450,000. He's grown it significantly. He'd now like to sell it for just about $2 million, $1.95 million. He intends to retire permanently from the workforce when he sells it, and his personal assets are outlined in this table here. So he's got a main residence. Now, as I said, we can ignore that. He's got an investment property, which we can't ignore. He's got managed investments, self-managed super fund, car and boat, etc. The total's $2 million. Firstly, we want to just determine where are we at in terms of these tests. Firstly, we're going to have a CGT event. The CGT event has the result, or will result when he sells it, in a significant capital gain. The maximum net asset value test. Now, the total of those assets on the previous slide, we take the business, which we said would sell for $1.95 million. The investment property, we can ignore the residence. The managed investment of $200,000, we can ignore the self-managed super fund, and we can ignore the boat and car, etc. So our net asset value position is 2.54, which is obviously less than $6 million. Then we start to look through the other tests. Firstly, has he owned the asset for more than 15 years? No, so he doesn't qualify for that aspect. Does the asset meet the active asset test? Yes, it does. There's no passive assets in there. Has he used the retirement lifetime limit of $500,000 before? No, he hasn't. He hasn't done this before. He needs to make and maintain an election. We'll talk about that in a moment. And we need to take into account, obviously, some age-based options around what that actually looks like. So how does it work? Firstly, we've got to calculate the gain. What gain are we talking about? We're going to sell the business for 1.95. But we bought it for $450,000. So we've got a cost base on that asset of $450,000. Our gain, therefore, is $1.5 million. The next thing we have to do is take into account the standard CGT discount. He's owned it for more than 12 months, so he can apply the standard 50% CGT discount. So our gain goes from 1.5 million to 750,000 is now the assessable gain. We then say, because it's an active asset, we're going to reduce that again by 50%. So we've got a $375,000 reduction. Our assessable gain then is $375,000. We haven't used the retirement exemption lifetime limit before, so we're actually able to use that for that last $375,000. And in fact, the assessable gain therefore becomes nil. So even though we've had a gain of 1.5 million, we've been able to use the concessions to get that gain down to nil. Let's have a look at this example. Based on age, Francis is over 55. I don't know if you remember, but in the slide he said he was 59. So Francis is 59 years old. He has two exemptions for the part of the proceeds representing the CGT retirement exemption. So right at the bottom there, we talked about retirement exemption of 375. Now there's two things he can do here. Firstly, he can contribute that amount to super. So that would be option 1. Option 2 would be he can take it as a cash lump sum. So let's just have a look at, obviously there's 2 options there. Now you can do either. It's Francis's choice to execute that. A lot of people roll that money into super, but you don't have to. You can take it as a cash lump sum because he's over 55. Now, separate model, case study number 2, Brad and Kim, married couple in their late 30s. They own a hairdressing salon. Very, very creative marketing. It's called Bradcat. They're the only shareholders in the business, which they've owned for 10 years. Brad owns 80% and Kim owns 20%. So Brad plans to work for another 10 years. Kim wishes to sell her share of the business. Brad has offered to buy out Kim's share of the salon. Let's have a look at how this works. Current value of the business is as follows. The salon's worth $1 million. We purchased it for $500,000. Goodwill is worth $100,000. There's no cost base. Cash account has $200,000. That's not an active asset. It's passive. And so that will be an issue for us. The couple's other asset is their residence worth $10 million, which is held in joint names. So firstly, Kim is going to sell her shares to Brad for $260,000, being 20% of the company's market value. The accrued capital gains $160,000, Kim being entitled to claim 20% of the original purchase price as her cost base. Kim looks at minimising her capital gains tax gains position on the sale of the shares. Now, firstly, yes, she satisfies the maximum net asset test. The value of the joint share in the home is excluded. Kim includes the total net market value of the salon, not just her share. Now, that's important to understand. This is a married couple. And so whilst Kim only owns 20%, they're classed as small business CGT affiliates. This connects her to the business, and she's got to take the full value of the business into account when she calculates her net asset value. Now, that's an important thing to understand. She's okay in this case because it's still under $6 million, but a lot of people get caught on that where they only own 20%, they take 20% of the value, but in fact their husband or their wife owns the other 80% or some part of that, and that does breach the tests. Kim's shares are active assets, and so we can get that qualification as well. We have no problem there. Now, Kim must be either a significant individual of the business or spouse of a significant individual. Now, that's important to note. That's not just, you can't just say I'm a spouse of a significant individual. The spouse has a small business percentage in the company or trust that is greater than 0. So there must be some level of ownership there in order to be a CGT Concessions stakeholder and therefore able to access the concessions. Kim is actually already a significant individual. She has a small business participation percentage of at least 20%, and there's no problem there. Kim's shares in the salon are considered active assets as long as the market value of the active assets of the business pass the 80% test. And we'll have a look at that table in a sec. Here's the model. We've got the $200,000 that sits in our cash at bank account. That is a non-active asset or a passive asset, but our active assets are 1.1 million. Therefore, we still meet the 80% test, and that's quite important to manage to make sure that that's the case. Now, how do we minimise Kim's CGT liability? Firstly, she hasn't held the shares for longer than 15 years, so we can't use the 15-year retirement exemption. Importantly, we did say in the introductory slide that Kim's not intending to retire. She's going to continue on. So even if they were held for 15 years, Kim won't qualify for that because she's continuing on. She's not wanting to look at the small business rollover concession. She doesn't wish to start another business or do anything like that. So that's not eligible. That's not relevant either. Now, she is relevant, obviously, for a couple of key things. Firstly, the small business 50% reduction. The basic conditions are satisfied. The CGT retirement exemption, 100% exemption up to the $500,000 lifetime limit, but you must make an election. So the election must be made in writing with the CGT exempt amount paid to a complying superannuation fund, mainly because Kim's in her 30s. So that's got to be done, and it's important that that's done correctly. Kim's also eligible for the 50% individual CGT discount. So firstly, we're going to use that first. We nearly always do that. We need to have a look at that and see how that's done. Kim will first reduce $160,000 capital gain by the individual 50% The remaining capital gain then can be further reduced using the 50% active asset reduction. So you can see in option 1, we've got the exempt amount there. We're going to get them both down to nil anyway. In the second example, option 2, we haven't elected to use the 50% active asset reduction. We're going to use the retirement exemption. $80,000 must be rolled over into super because of her age. She can't take that in cash, as was the case with Francis in the previous case study, because he was 59 years old. So that is a different treatment as well. So firstly, we've got obviously option 1, and this is assuming that Kim doesn't want to roll the full $80,000 into super, that she'd like to have some of that in cash. Option 1 only requires $40,000 to be rolled over, not the full $80,000 under option 2. If she wanted to increase the super balance, she could easily make a non-concessional contribution into super from part of the balance of the proceeds of the sale. So generally speaking, option 1 there is a more favourable outcome. Now, hopefully that's been helpful, just to give you a few worked examples and show you how the concessions work and what the key criteria are. Let me just finish off. We're looking, as I said before, at the CGT concessions. The slides and the recording of the webinar will be available not too long after we finish, a couple of hours to process that, etc., and put that up on our content hub or resource hub on our website, successionplus.com.au. They're free. You don't need to pay or do anything like that. You can just download the materials and use them for training, etc., internally if you want to do that, or just to give yourself a bit of a reminder. The recording will be available as well. As I mentioned to you before, we are actively looking to recruit accredited advisors throughout the country. There's some areas nominated there where we are looking for accredited advisors. You'll notice quite a lot in Victoria, including Melbourne itself. We've actually got accredited advisors in most of the other capital cities, but Melbourne and Victoria, we certainly are looking for more accredited advisors. So if you're interested in that, please contact me. In terms of the Masterclass series, as I said to you before, we're partway through. We're sort of 4 classes into a 10-class series. The remainder of the dates are on the screen. It's generally speaking the second Thursday of the month, and it'll come up on your screen there, each of the following dates. Family business succession is the next topic, quite specifically targeting around families and the particular issues that they need to or have to deal with. Then we're going to look at maximising value. What are the things that buyers are really looking for as we head towards the M&A type topics? We're going to look specifically at an option, a succession option, which is around employee share ownership plans. That's an area I've done a lot of work. I'm actually 3/4 of the way through a PhD on the topic of using an employee share plan as a succession tool. And so we'll look at that in August. And then in September, some strategic sales. What are buyers really attracted to? What will encourage a buyer to pay more for your business? And then the last 2 things will be an M&A process, the tips and tracks to sort of look at around preparation for a mergers and acquisitions activity, a transaction or an event. And then lastly, an action plan. How do we actually put all that into place to offer these types of services to our client base, who probably consists of aging baby boomers heading towards or thinking about retirement. So I hope you can join us for at least some of those, if not all of those, upcoming advisor masterclasses over the next few months. I've certainly enjoyed putting the material together for you and having a look at it. Obviously different topics, some more technical than others. Hopefully today's coverage of the capital gains tax, small business concessions has been useful and interesting, particularly the case study examples of how the CGT concessions roll out. I'm happy to answer questions if you've got them and cover off on anything that we missed or that you wanted to go back over. I'm happy to do that now through the chat function on your webinar console. I'm also happy to do it separately later if people have got specific questions with clients or so on that they do want to ask me. I'll put my contact details on the screen. My email's up on the top left-hand side there. Please feel free to email me through any questions or queries you might have. I'm very happy to help. If I can answer those, I certainly will. Happy to answer some questions now if people have questions to have a look at. Happy to go through those as we go. Okay, so I've got one question there. Is there somewhere we can download the material? So there is. The copy of the slides will be available and the video will be available as well shortly in the next sort of couple of hours. They generally go up mid-afternoon this afternoon. So please feel free to just log on, download, review the content. There's also a CGT Concessions white paper available on our website. I'll make sure that that link's forwarded to everybody so that you can actually download and use the white paper, which is a bit more of a technical description, step-by-step of the process and what's included in that. So very happy to provide those contacts, those content pieces for you to use at your leisure. Next question, accredited advisor, how does the process? Okay, so the accredited advisor process is simply a methodology whereby we can leverage our IP and technology. We've developed quite a few tools and systems to use for business succession and exit planning. If you become an accredited advisor, there's an upfront training component and a license agreement that then allows you, once you're trained, to go away and use those tools and processes with your clients to help deliver succession and exit planning. So feel free to ask more about that. Unless there's any other questions, we're 5 minutes early, but I'm very happy to round things off now if people don't have further questions. If you do need further help, please feel free to contact me or email me, and we'll see what we can do to help resolve your questions. Thank you for joining us, and I look forward to catching up with you next time.